All right. Good morning, everybody. Not sure what's up with that link. I'll revisit it. I used Bitly to condense the link size, and I'll have to just go back to Bitly and check to make sure there's no error issue over there. All right. So, like last week, this week we have the anticipation of a market on pause while we wait for the FOMC, but I don't really believe it. Last week showed us that there's still a heavy weighting. FOMC, believe it or not, is not the biggest threat on the table this week either. So when we're talking about, interest rates around the world and changes to those rates, European Central Bank is going to make rate decisions this week. They have been really good at coming out and kind of letting everybody know it's that messaging, right? They don't want to surprise the markets. And the US Fed has done a really good job of kind of explaining their position. And so there's not really an anticipated surprise there for the FOMC. What everybody's going to be looking at is what do we do going forward, not what is the decision going to be Wednesday. It's almost guaranteed that they're going to hike at this point, right? It's like 90 something percent certainty they're going to hike. But what are they going to do for the next one? Are they going to actually announce a pause? Are they just going to reserve their right to hike, but not necessarily say they're going to, right? That's the kind of thing that we're going to be looking for this week. The unknown, the biggest threat to volatility this week is Bank of Japan. And that's going to be on Friday. So, as much as everybody hypes up the FOMC, we pretty much know where they're at. But with Bank of Japan, there's so many unknowns. We got the new guy, right? He just took over. There's a big discussion on whether they're going to maintain those yield control tactics, and if they're going to maintain it at its current levels, like, leave everything unchanged, or are they going to start trying to change something? So there's a lot of unknown there. And I'd argue that it's a bigger threat than FOMC itself. So that's going to be the big one on the week. When I find new websites, new products, new things, I like to, kind of showcase them or highlight them. I haven't used the full version of this place, MNI, but just hopping around through their free material is pretty amazing. It's news based, right? They're aggregating news from around the world, but it's that world word that really gets my attention as I'm in here. I've been using it for a couple weeks. They do a great job. For me, I'm just catching the headlines, but they do a great job of kind of highlighting what's going on around the world. And it's become a little bit of my go-to in the morning, where I come in and I just see maybe things that aren't landing on finance juice, but that might have a little bit of impact. And it's funny, if you hang out, you'll see them typing in a new headline when things come through, right? So it's pretty good for emerging markets and global markets until our trading day really gets going. It's called MNI. We do have some large earnings on deck this week as well, right? So it's not just the rate decisions globally, but it's also things like Microsoft. And Microsoft is so big that it absolutely has the weight to move markets. And, kind of keep in mind too, It's not just what they report, it's what they talk about. For an example, there's bank CEOs who can give a forward outlook on how they see economic projections in the US and absolutely move markets. So, when it comes to companies that can move things, Microsoft is one of them, no matter what their earnings is like. Just during the announcement, if they happen to say anything about their forward projections and how they view the ability to make money over the next quarter, it can impact markets. But we've also got Google, it's a busy week. Facebook, something I wanted to add about liquidity in these markets. There was a great segment on Stock Charts on Friday that showed, the loosening of monetary policy since that bank crisis has actually got us to right about February or March of 2022, right before things really keeled over and we had that bear market drop in the S&P. So even while they're still hiking and we're sitting, in 5.25, things are actually not that restrictive. And if their goal was to get into mildly restrictive territory, well, their little bank bailout nipped that in the bud, and it didn't quite work out the way they wanted to, perhaps. You should be able to find it if you go looking at stockcharts.com on YouTube, see what came through over the weekend, or it was a Friday post. Okay, so you can see it's a pretty light morning at 8:30. Got a little bit of volatility, 9:45, and then additional auctions at 11:30 and 1 o'clock. These are really the front end of the curve. I mean, really right up close. And while I would never say, ignore data, I don't hold these in such a high regard as I do the, farther out on the curve. There's still something you want to watch. Absolutely keep track of the time, right? Look at what time it is. Make sure that you're aware of the volatility that can come in when these auctions come through. But after 1 o'clock, you should be good to go for you 0-day traders. Volume is within acceptable levels. It's not too light. It's not too heavy. A little bit of Goldilocks. We had a move through the kill zone from 2 to 4, and it didn't reset itself, which is worth noting. Really narrow IB. We've already gone through the weekly and the daily pivot, and we're actually holding above both. So no MDPs or anything like that. We're inside day, just about in the middle. So we got nothing, right? If we take this out to the weekly for a moment, getting above, closing above the 1.5 opens the 2, right? But the problem is we're still in the middle of this range. And that is very likely going to be half of our week right there. 46.09, 45.28. So it's about an 80-point range. We could, kind of wink out, but we're expected to come back in on both sides. That would start to create the megaphone pattern. And there's no real expectations that we expand beyond this level, except for maybe a little bit, right? Break out and come back in. Having said that, we are primed for a 10 MA bounce on the daily. Now we can cut through it first, right? Get a little bit of an overshoot like we did back here where we cut through it. Just keep in mind that moving averages are not support and resistance. And as you can tell, we're not moving too far too fast. We haven't outrun the 10. We're not getting parabolic or anything like that. We're not overbought. $10-day, 30-minute volume profile. We're going to lose this lower volume structure as the day goes by today. Unless the news happens to shove us back down there, we're very likely not going to get this air pocket dealt with. But remember, Wednesday with FOMC, we're gonna very likely see some intraday volatility. And at that point, let's see if we can, it would look a little more like this as we get into Wednesday. So a break below 4,500 is going to be a level worth watching. We can wick through it, kind of come back up again. But if we break through that 4,500 with conviction, it puts us in this air pocket where we can move really fast. And you can see how we did that already the last time, right? When we went through there, we went through there really fast. We don't really have a classic shape yet, but by Wednesday, if we haven't come back down into this level, we will have a D shape. And the point of control has been brought up like we talked about last week. So it's really close to us at this point. 45.50 is a gamma level. And it's also the point of control for this 10-day. Just remember, when we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We still have the VPOC in place. It just needs to change where it started from. So here's Friday's point of control. Remember, we were using it from Thursday. So 45.78, we got a VPOC. And we've got a half back at 45.68. Starts to get us in that shallow area. And we could drop through that relatively quick. That's what happens when you get that move through the kill zone, right? That move from 2 to 4. So this morning we have a V shape. All right, you can see the range that I drew maybe 5 minutes ago is well within the range for the weekly expected move. Right? This shouldn't be a surprise. We're expecting to stay inside that box that I drew until at least Wednesday afternoon when we get the FOMC announcement. At that point, all bets are off. I am curious, and we want to check how much more volatility they priced in from last week to this week, knowing that this week is an FOMC week. Not much. Right? You can see the range for this week is just marginally bigger than the range from last week. So even though it's an FOMC week, they really aren't pumping up the volatility that much. Expectation being that they're not expecting a big move. The market's not expecting a big move. There's a little bit of edge in that, by the way. Remember what I've said before, when everybody thinks there's going to be a big move, it's the hype, it's everything you hear, everywhere you look. It's like, oh man, it's going to be a big one. And then nothing happens. Well, the reason nothing happens is everybody hedges the hell out of it, right? You don't have to worry about selling something if you've got insurance on it and you're hedged to the eyeballs. And of course, if you're hedged to the eyeballs and you don't have to sell anything, there's no volatility, we don't get a big move. But when everybody gets complacent, nobody thinks it's going to be a big move. There's no pricing in of hedging showing up, anything like that. Now we've got the potential for a big move because they seem to be thinking there's not going to be a big move. We are 3.1% above the 10-week. We've pulled away from that 4% area nicely. Everything is looking really good here. We don't want to get out of control, right? We don't want to make massive runs that get us overextended and cause us to, look like a parabola or something like that, right? And while this doesn't really have a clean shape to it, this is a wave, right? These are little microwaves. Microwave. Huh. So we're on the downside of this curve. There's the expectation that we will come back close to zero. The visual for that is the market coming back down and bouncing on that 10-week. The thing is, it doesn't have to come all the way back, right? It can just, come in a general direction. We really don't expect it to get below zero, or if it does, we don't expect it to stay there. And in a shorter duration, the 10-day. We're not even 1% away from the 10-day at this point, and we are on the downward cycle. So there's an expectation that we could pause here and begin a new cycle back up, or that we come on down and tag that 10-day. But not even 1% away from the 10-day. We're not overbought. We're not overextended. We haven't gone too far too fast. And this thing doesn't owe us a pullback. And it's still bullish. It's still healthy. And we can continue to go up. Not just in the S&P and in the market, but a broad market. This is my sectors grid. Kind of like to revisit it at least once a week in the morning briefings. The top three are the risk on, The bottom three are the risk off, and the three in the middle are what we call the midline. There's an expectation of a capital rotation on the way, right? And someone has this phrase that I absolutely love, and it's not my phrase, right? So I'm not trying to take credit for it, but the way they say it is, if you don't get your sector rotation, you're going to get volatility. Now they say it a little better than I just did, but the meat of that holds true, right? No matter how I say it. If we don't get this sector rotation, we're going to get volatility. It's going to be one or the other. And we can see, looking down at the lows here with the XLP, XLV, XLU, look at the drive over the last 4 or 5 days in healthcare, or over the last 3 days in utilities. And kind of match that against what we have, say, in tech or in consumer discretionary. So energy is just about ready to re-challenge that 200-day moving average. Utilities strongly above that 200, right? No joke there. It just took it. Same thing with healthcare and staples above both. Staples has actually got the healthiest chart out of these three, because the 50 is above the 200 and price is above both. But destiny being what it is, it really doesn't look like that 50 is going to turn around in time, and we're going to get a 5200 cross. So, it's getting a bit sideways. It's very likely we're going to see a cross kind of like what we had back here, where it just dips down and comes back in again. Same thing with healthcare. It's nearly flat at this point, that 200 period moving average. And so the 50 is just snaking back and forth through that level. But we're getting into some key structural areas here, and we're primed for a breakout. Energy, utilities, healthcare, staples, maybe a little bit of industrials, but that's not looking as good as these, right? It looks like it's stalled, and these look like they've been expanding nicely. Same thing with building materials. So industrials and building materials is kind of on the fence. Maybe if you were to selectively pick out 1 or 2 names, it wouldn't be that bad. But or approach it from the idea that they haven't even begun to get flows yet, right? These have already started to move, these 4. So you're playing catch up. But building materials and industrials, they look stronger than tech over the last 3 days. We could certainly say that. And they haven't made the expansion yet. So maybe you're a little early. I'd be watching these for a breakout and an expansion. The idea behind it is you want to open them up and get the strongest names out of that list, right? I've got shared charts, but they need to be updated. We found that out last week, right? When we were looking at my KRE list. Come on, Thinkorswim. So you want to go in and open up the ETF itself. This is XLU, and then find the top weighted names within that ETF. All of these have been shared in the Thinkorswim workbook, but like I said, they're old. They need to be updated. Depending on your broker, you can go on Thinkorswim, you can go to fundamentals, and you can see the top 20 holdings, or all of the holdings if you want to see all of them. So, Procter & Gamble, Pepsi, Costco, Coke, Philip Morris, Walmart, right? You kind of get the idea, right? So for you swing traders, or, you position traders looking for what's next, I don't think it's going to be tech and finance. So we got XLP down here. Breakout continuing from yesterday. That's what it had. The market's not open yet, so this hasn't updated that column, but kind of goes with what we're talking about. The TMV is bullish. The impulse is bullish. The CAM has upside momentum. And for being boring old staples, it's got a market maker move right now. Remember, a market maker move is based on trading activity within the options chain. When the front series has a higher implied volatility than the next series out, you'll get a market maker move. And we got 1285 versus 1235. This push that we saw this morning in the S&P, where we got above the VWAP and we had a nice little expansion extension, came on the back of the 10-year, right? So we had that nice little fade here in the 10-year and a nice drop back down after US dollar Japan had a rising wedge breakout to the upside. Remember, rising wedges are supposed to break to the downside, right? And so what you get sometimes is a blow off top move where it'll shoot nearly straight up and then come back down, break through the wedge, get through the bottom of it, and then we'd have our measured move. This is a really squished rising wedge. There's not much of a measured move to it. It might get us back down to that 139, which is a monthly level, really expecting to catch support there. Not much out of the past that. But the big deal when it comes to US dollar Japan is, one, remember I talked about it earlier, Friday is going to be a really big deal, Bank of Japan. Two, how fast this thing is moving matters. So sure, it could very likely, and not could, it is very likely going to find support at 139. But how fast we get to 139 is going to be a big deal. So if it drops like a stone in water, the S&P getting above, say, 4,600 shouldn't be a problem. If this thing is choppy and grinding around all over the place and kind of ekes its way down there, it'd be a different story. Same thing with the dollar. It doesn't really have much of a wedge shape to it or anything like that. It just had the little pop and a breakout. Right now, it's either going to be a Busby or it won't, right? And if it doesn't, then we're going to look to get below that 101 and start getting back down to 100, the psychological level. And the same thing with the dollar. How we get down there is going to be what matters, right? If we drop there really fast or if we grind our way down. This move in the 10-year this morning, for an example, that really fast, sharp move straight down. That's the kind of stuff that can cause this move hard and fast to the upside, right? So the ZB got defended back on the 7th. They're still doing well. It's holding up, but it's just not really getting anywhere. So need to keep our eye on this in case it wants to drop back down and re-challenge that 126. Otherwise, we're going to look for a continuation and an expansion here and have stocks and bonds both rising, right? That risk parity is dead, right? What's the phrase? It died with COVID. That's an awesome line. It's not mine, but I love it. All right, so we can't look at the NY Fang in the pre-market, right? That we just don't have It doesn't move in the pre-market. So we can use a little homemade ETF, and or we can use we can just individually go in and look at each one of the names. We got a pretty flat market out there this morning. We're not positive, we're not negative. Get used to this because it's very likely going to be our week this week, right? At least until Wednesday, possibly the whole week. I really think they're going to stay on pause, waiting for US dollar Japan, right? We're waiting on Bank of Japan. Which means through the FOMC, if you're expecting a volatility drop on the other side of FOMC, you're very likely not going to get it. They're going to keep that volatility in there. It wouldn't be the first time, right? And I haven't had a chance yet to read Spot Gamma's founder's notes. When I do, if they are expecting the same thing, that's where we'll get confirmation of it, and I'll be able to cover it in tomorrow's briefing. I don't want to hold you guys up while I go over there and look and see what it says. Let's see. We got bonds with some sizzle. We got to kind of hold that with a little bit of like a grain of salt. Some of these ETFs carry the after hours from the previous day, not a pre-market in today's levels, right? So maybe we'll just jump over and use TrendSpider. Or not. That's not very impressive. All right, things are moving around a little bit in the bonds. Got TLT making waves. Out here on the weekly, we got a whole lot of nothing. It's a continuation of the nothing that we've already had. We got to get out of this range, right? So they did a good job defending that low. Great. But we're past that point, right? We're only going to pat them on the back so much. Now they got to finish it. They got to get over that level. So that's what they're working on this morning. This is why we came over to TrendSpider. I was looking at Shy on Thinkorswim, and I didn't trust it from being something that had moved on Friday after hours or something that was moving in the pre-market this morning. We can see it's pre-market, not a whole lot of flows yet, but it is on the move. And that's the front end, right? And remember, we got additional auctions today in the front end. It's all tied together. IWM is really working on this trend line, needs to complete the breakover. Hit resistance, pulled back in. We need to get that follow through, right? So IWM above 196 offers 200, but 200 is where we still have a lot of unfinished business. So be really careful there. That's a rally based drop. And that's assuming that we can get to 200 because we still got another one here, rally based drop. So With the pair going down, US dollar, Japan, it's likely we're going to see gold, silver, miners getting a little bit of a pop to the upside. Taking it out to a weekly, we've still got issues. We're barely above the 10, but we're tangled up in that 20. And even if we do get above that 20 week, we've still got a lot of resistance at 186 and then 189. So, just kind of look at all of this up here. Every time we get up into that level, there's just massive sellers waiting up there. And until they're done, we're not going to make it through that zone, right? We need to see what the book looks like when we get up there. Yeah, same thing with silver, range bound. We got to get out of the zone one step at a time. Silver's not even getting any love yet, which is odd. I don't know what to think about that. It should be up this morning with US dollar, Japan going down. And the fact that it's not is a little odd. Just approach with caution, right? If US dollar, Japan comes into that support level that I mentioned and starts the bounce and a rally back up, these precious metals are going down, very likely going to go down. Last week, they started to correlate. They had a positive correlation, which is not normal, but it can happen. And that's what it really seems like with silver. It's still positive correlation with US dollar, Japan instead of inverse correlation like we got with US dollar, Japan, and gold. All right, some big moves in US dollar or in emerging markets implies that we could get a China ADR lift this morning. Might want to take a look at things like BABA, Baidu, PDD, JD. Because if emerging markets starts to pick up, then these are going to start to pick up, right? Emerging markets has got a lot of China in it. I argue China doesn't deserve to be labeled an emerging market anymore, but hey, it is what it is. So KWeb nearly back up. Think of this as a liquidity gap, just like when we get FOMC or not FOMC, but non-farm payrolls, CPI report at that 8:30 thing that can really drop the market or spike the market, causes a liquidity vacuum. This is a liquidity vacuum. It's trying to get it reset, and then what? That's going to be the bigger question, right? So you want to be watching not just KWeb, but JD, BABA, Baidu, to see this get reset, and then kind of keep your eye on what it's going to do next. Because we could get a nice red to green here. So in Baidu, we're still below that 140 level. If we can get back above it, we can start to rerun this IX10. It's a weekly IX10 at this point, and it's pretty wide, but when we take it to the daily, that is a perfect TRB setup. And remember, a TRB, one of the reasons I like them so much is on the breakout day, you can get a day that moves 3 times the size of the average candle within the zone that you're looking at. So if this thing's got a daily ADR of 2.6 or $3, $3.50, then we could get an $11 move in Baidu in a day. You're talking about going from 140 up to 152 in a day. That'd be a nice move, right? But it's got to do the thing. And there's a lot of trash in the middle of it. 10 and 20 overhead. It's not even going to draw a nice line, right? It's just we'll just throw it on there, kind of in a floating, just to visually represent that it's there. That is the TRB setup. To confirm that it's TRB, we got to get above 144. So until that happens, until we begin the breakout, it's not a TRB. It's just a setup for a TRB. Baba is looking a lot better. Looks way more healthy than Baidu. Technically, this is a TRB setup, but it's really wide and not very clean. When you get into candle analysis and candle education, candle books, things like that, they will say that if the pattern is there, then you count it as a pattern. So no matter how ugly it is, it still counts as the pattern if you believe that other traders can see it and it will follow through. But then it comes back to the old chicken and the egg, right? Did we move because everybody saw the pattern, or did we move and that created the pattern? You know, it's kind of one side or the other. I think the answer is yes to both, right? That it's not always one or it's not always the other. If either way, if we get this continuation in the emerging markets and a little bit of the bounce play with everything that we've covered this morning, then we could easily see BABA back up into that 97 area. Pot stocks are getting a little attention this morning. Not enough yet to really drive the boat, but it's a good start. Right, so they're not really negative, and we got a couple of positives. I think a couple of those positives can carry the rest of them, right? At least get it started. Rising tide lifts all boats kind of thing. And energy is getting some attention. I did go over the sectors earlier, so we already know that energy as a sector is very likely going to start getting some positive moves. But we got USO up this morning. Got a trend line breakover and then resistance. Let's get through 70 and we can aim for 75. Just remember that these ETFs, you know, they don't normally make really big sweeping moves. All right, so we're a little bit more in sync than we were last week. There was a pretty big divergence between the S&P and the NASDAQ last week. I think they're a little tighter correlation. But right now, the weakness is in the S&P, and it's taken the NASDAQ with it, not the other way around. So watch the KRE NY FANG divergence. Remember, there's no financials in the NASDAQ 100. So if the S&P is weak and the NASDAQ isn't as weak, then it's those financials. If we get a turn in those financials, then we could see a challenge of last week's highs. Right, nothing in KRE. Nothing in XLF, which makes sense, right? The ES is down, just crossed back below the VWAP. Looks like it's going to try to expand lower from there, and we don't have anything positive in the financials. All of the FANG names are popped higher than where we went into the close last week. None of them really look like an inside day breakout. They're not that strong, but they're certainly looking better than the financials this morning. If we lose those and they start heading down while the financials are still weak, we could test the bottom side of the last week's range. That'd be a nice reset too. The big thick lines that are running clear across the screen are the spot gamma levels. So if we break below our own Globex low, we'll challenge Thursday's low. Beyond that, we're going to aim for the 10-day moving average. It's 45.45. 45.50 is a big gamma level. It's going to be like very likely the put wall. But like I said, I haven't read the founder's notes for today. I don't know all the pivots. But 45.50 is a high gamma level. 10-day underneath that. 21-day ADR. And then 45.38, which is really close to the cog line. And it's really close to a voodoo line. That's a snow line, 45.38. And yeah, we could pull all the way back down to 45.30, heck, 4,500, and we still wouldn't be in a bearish market, right? So it's not like we're going to be all bared up, just dropping down to 4,500. It'd be a nice little reset and get us back down and bounce on that green line, which is the 20 period. Right, we're back into the old buy the dip mode. So a nice little dip. We're just looking for another one, right? So what I got, guys, be careful, be safe. I'll have more information after reading Trading Ticks on what the expectation is for volatility after FOMC. I'm pretty sure they're going to say we're not going to see it pulled out until Bank of Japan. I'll see you tomorrow.